Welcome back to Investing Talk Podcast.
Today we're looking at stock.
As usual, before we start, subscribe, like, and comment to this video to support the show. If there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's.
We have a fascinating company here, stock, which, operates in the digital health sector. What really stands out just right off the bat is the growth momentum combined with expanding profitability.
Okay, let's unpack this. We've seen some really explosive top-line growth. I mean, Q3 2025 revenue hit nearly $600 million.
Which is a massive 49% year-over-year increase.
A huge increase. It's worth noting that this followed an even stronger Q2, which saw 73% growth. But I mean, the pace is still incredibly robust.
Right. And what's so interesting here is that they aren't just chasing revenue. That's not the whole story. They are scaling profitably. Q3 2025, it actually delivered positive net income of nearly $16 million, and the adjusted EBITDA was over $78 million.
And if we connect this to the bigger picture, management's full year 2025 revenue outlook is set pretty high, right?
Yeah.
Between $2.335 and $2.355 billion.
Exactly.
And here's where it gets really interesting for me. The market consensus projects a massive, a 77.8% improvement in 2025 earnings per share over 2024.
Yeah.
That's a signal that sustained profitability expansion isn't just a hope, it's actually expected.
And that acceleration is driven by their subscriber base. It grew about 21% year over year to roughly 2.5 million users.
Okay.
But crucially, the revenue per subscriber also went up 19% to $80 per month.
So they're getting more customers and more value from each customer. It's a two-pronged approach.
That's it. They're getting them in the door and then upselling them.
And they're putting their money where their mouth is when it comes to cash flow. I saw they just completed a $100 million share buyback program.
They did. And now the board has authorized a new one, a much bigger one, $250 million.
Wow. Okay, so that level of capital allocation, that signals some real management conviction in their current valuation, doesn't it?
It absolutely does. Let's pivot to the competitive advantages.
Right.
Because stock has successfully created what looks like a durable moat.
Okay.
It's based on two key elements, its subscription model and its broad sort of integrated care suite.
So tell us more about that subscription platform. Why does that make it so difficult for competitors to break in?
Well, it's a recurring revenue engine with really high switching costs. Think about it.
Right.
The company offers these integrated treatment plans across sensitive areas. Mental health, sexual health, dermatology, and now weight management.
So once you're in their system, it's a hassle to leave.
A big hassle. By establishing these long-term personalized relationships, they just increase customer lifetime value and lower churn. I mean, we saw customers on personalized subscriptions surge 80%. They now make up over 65% of the base.
And they're moving to weight management, the whole GLP-1 market. That's been a huge catalyst, correct?
Absolutely. A massive one. They've leveraged their telehealth and pharmacy infrastructure to just aggressively enter the space.
Which has a gigantic addressable market.
It's huge. And on top of that, they're strategically expanding into new categories, things like sleep, pulmonology, menopause, and low testosterone.
And that's not all their funding either. I saw they raised, $870 million through convertible notes?
They did. And that money is specifically to fund AI integration, diagnostics, and global expansion.
So that suggests a shift, right, towards more proactive, whole body lab testing and care management. It's a different model.
Exactly. And in terms of that global growth, they've already acquired Zava.
Right, which gives them access to major European markets.
Over 200 million adults. And they're also officially expanding into Canada through the acquisition of LiveWell. This international runway just further entrenches their moat against any rivals who are just focused on the U.S.
Okay, so while the fundamentals do look strong, no investment is without risk. We have to talk about the other side. What are the key headwinds we need to discuss?
The primary concerns, really, they center on two main areas, growth deceleration and litigation risk.
Okay, let's start with growth. We mentioned the revenue growth slowing from 73% down to 49%. What does the future look like there?
Well, the forward guidance suggests it's going to continue to decelerate. Sales growth for 2026 is projected around 17.6%.
That's a significant slowdown.
It is, and it's what's making some analysts pretty cautious. Management also conceded they've paused year-over-year margin expansion.
To fund all that ambitious expansion we just talked about.
Exactly. For example, Q3 gross margin saw a 500 basis point decline down to 74%, and that's due to increased GLP-1 fulfillment costs. They do expect this to normalize, but not until the second half of 2026.
So the bullish take is that the margin compression is a strategic choice, not some kind of competitive failure.
That is the bullish interpretation, yes. But the biggest immediate headwind is regulatory and legal exposure.
The class action lawsuits.
The securities fraud class action
Yeah.
lawsuit. Yeah. It alleges misleading statements regarding promotions for, let's say, illegitimate Wegovy versions. And this carries a pretty significant bearish sentiment score in the market.
And that lawsuit could carry substantial settlement costs, not to mention regulatory scrutiny.
Yeah.
So what's the mitigation for the learner to consider here?
Well, the $78 million plus in quarterly EBITDA provides a really substantial financial cushion against potential settlement costs.
That's a good point.
And maybe more importantly, management authorized that huge $250 million buyback after the Q3 earnings beat.
So after the lawsuit was public knowledge.
Correct. Signaling their confidence that this litigation risk is manageable and maybe already somewhat priced into the stock.
Okay, so shifting gears to market signals. Despite that near-term weakness and the litigation overhang, you're saying the technical setup is actually pretty constructive for bulls.
It is. Quant models are flagging an exceptional 112.6 to 1 risk-reward setup.
That is an incredible ratio. What about institutional flow? Is the quote-unquote smart money buying or selling?
We've seen mixed signals, but the accumulation from some very sophisticated players seems to outweigh the exits.
Such as?
Specifically, Tidal Investments added over 2.7 million shares in Q3. That increased their position by almost 1,800%.
Wow.
And Renaissance Technologies, a massive quant fund, also added over 2.2 million shares. This suggests that some institutional conviction is rotating into stock.
The buyback news itself was an immediate market catalyst, wasn't it? It drove the stock up almost 3% pre-market.
It did.
So what are the major calendar events coming up that investors need to be watching?
The immediate focus is the Q4 2025 earnings release that's expected in late January or early February 2026. The market will be scrutinizing that report to validate the full-year guidance and get some clarity on the 2026 outlook.
And that 2026 guidance is key, especially how the subscriber growth holds up and what management says about the timing of those AI and diagnostics product launches.
The ones funded by that massive convertible offering, yeah.
Exactly.
And, any update on the litigation front could also remove a significant short-term volatility drag. We should also note the high short interest, it's around 35% of the float.
Which means any positive catalyst could trigger a rapid move higher, a short squeeze.
That's right. So this raises an important question for you, the listener. Given this mix of accelerating EPS growth and the significant risks, regulatory scrutiny, litigation, how do you weigh the confidence shown by management's massive share repurchase against that elevated volatility?
Yeah.
It really is a classic case of growth versus risk.
The fantastic thought to mull over. If you found this discussion helpful for your investment research, please hit the subscribe button, like, and comment to support Investing Talk podcast. We'll see you next time.